Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, Director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast.
Welcome back, everybody. Today, we're going to have a conversation about delegated money management. And particularly, we want to also focus on an asset class that has received a lot of attention recently, which is alternatives. And so, Jonathan, when we talk about alternatives, I generally think about private equity and hedge funds, but it's probably even broader than that.
Yes, definitely, Jules. So let's think about it as the two categories, mutual funds and alternatives, but let's define them this way. Let mutual funds be what we call public delegated management, which is when anybody in the public can invest in a mutual fund, and the mutual fund generally invests in publicly traded stocks. The other space is what let's call it private delegated capital management. And the private delegated capital management, usually it's privately intermediated. Not everybody can invest in a hedge fund or a private equity fund or a venture capital fund. And in particular, these funds invest usually in private investments. Although not always, often hedge funds also invest in public markets.
And so what I think we want to do in this episode is explain clearly why these two spaces in certain aspects are similar, but in very important aspects, they're also quite different. We're observing different behavior. We're observing different contracts. We're observing different vehicles in the alternative space than we are observing in the mutual fund space. And so to create that contrast, maybe we should first spend a little bit of time on mutual funds, because you, Jonathan, with Rick Green, have formulated a very elegant and simple model that turns out to be a great description of the mutual fund space. And you and I have done a lot of empirical work in the mutual fund space that confirms that. So in the mutual fund space, we have to think about a couple of salient facts that we're observing. One of them is, in mutual funds, we generally see that people charge what's called a fixed percentage fee on the capital that's being managed. That's the way that the manager is being compensated. So just say 1% of the $1 billion fund, we see that the manager receives a fixed percentage of that amount of money. So that's one fact. The second fact that we're seeing in mutual funds, which I think is a very salient and important fact, is what we call the flow performance relationship. The flow performance relationship implies that when a manager does better than expected, when a manager beats the benchmark that they're supposed to beat, we are observing that money flows towards that mutual fund, and vice versa. When the manager underperforms, we see that money leaves that mutual fund. And while the literature had really been confused about this issue, and a lot of people thought that the flow performance relationship was really an irrational phenomenon, I think that you in your work with Rick Green have really clearly explained why the flow performance relationship is exactly what you would expect rational investors to do, because after you see positive performance, it turns out that the manager is better than we thought they were before. And so that means that that manager deserves to manage a larger fund. And of course, because of the compensation structure that we just talked about, because it's a fixed percentage fee, that also means that the salary of that manager will simply go up by that. So fixed percentage fee, one, flow performance relationship, second. What are other salient facts that we should think about?
So prior to the paper, the dominant belief in mutual funds was that managers should make a positive alpha for their investors. They claim to be stock pickers. If they can pick stocks, why can't they make a positive alpha for their investors? And the contribution of that paper was to say, no, that's not the right way to think about it. Nobody gets a positive alpha for doing no work, and investing money in a mutual fund is doing no work. So what really happens is, if there's a manager who has a positive alpha, everybody wants to invest in that fund. And so capital flows into that fund. And as the capital flows in, there's decreasing returns to scale, and the alpha drops, and eventually it drops to zero, and then the capital stops flowing. And that is the important equilibrium in mutual funds, and there's overwhelming empirical evidence to support that.
So that's the third empirical fact. So the first empirical fact was fixed percentage fee. Second was a flow performance relationship, exactly as you described. Third one is mutual fund managers don't make an extra return in mutual fund markets. That's the third salient fact that we're seeing in the data.
And it's empirically absolutely true that they don't. Okay. Now, the next point that people were confused about was what you point out as the flow of funds relation. Because since managers did not beat the market, since the alpha was zero, it was unpredictable. And then people said, well, this is crazy because if a manager does well, funds flow in. Investors are chasing past performance completely irrationally because we know the alpha zero going forward. So a manager that does well is no more likely to do well in the future. Why is the funds chasing performance? And in fact, the behavioral economists used to cite this example as the best example of the irrationality of investors. In fact, they have it the other way around. The reason the alpha zero is precisely because investors chase performance. So just to go through this, if you find a manager and they suddenly have a better than expected track record, you update on that manager and you say, well, he's better than I thought. And so that means he has a positive alpha. Everybody does that updating and funds flow in. Until what point? Until the alpha goes back to zero. And the same is true on the downside. If the guy does badly, you pull money out and the money is pulled out until the alpha goes back to zero. And so the flow of performance relations, instead of being an irrationality, is a perfect example of the rationality of markets. The competitive nature of markets produces the fact that the alpha is zero.
Or to say that differently, suppose that investors wouldn't respond. That would really be the puzzle. Because that would mean that there is this opportunity and you have this positive alpha and nobody would be chasing it. That would really be a puzzle.
That would be a puzzle. Exactly. In fact, as I like to say, the big question in mutual funds, and a lot of researchers prior to our paper, even after our paper, use the excess return of the manager as a measure of the manager's ability, which obviously it's not. The alpha of investing in mutual funds tells you nothing about the manager's ability. It tells you about the rationality of investors. If the alpha is positive, it means markets aren't very competitive. And if it's negative, it means investors are stupid and they're giving money and it destroys value. As in fact, as our empirical work shows, they're not stupid and the alpha is exactly zero as expected. So in our work together, which I think has become quite influential, we have shown that the correct measure of the ability of the manager is the alpha he generates times the size of the fund, what we call value added. And we show, somewhat surprising this to us too, that you can predict, based on the current manager's ability, that in 10 years' time, he will still have that ability. It's an overwhelming, as far as I'm concerned, evidence that skill exists in mutual funds. And I would say, Jules, that in that sense, the mutual fund space is pretty well understood.
Yes. So just one clarification. When you say alpha times the size of the fund, you mean the gross alpha. So that means that the performance that the manager has in the market before we're subtracting the fees. As you explained earlier, the net alpha, which is the extra return that the investors are getting, once the competition between the investors has played out and they've all competed fiercely for the skill of the manager, they're not getting any net alpha. So net alpha is zero, gross alpha is a positive number, but the multiplication of the gross alpha with the size of the fund is what measures the skill. So now let's repeat these salient facts, which is, so it's zero net alpha, very clear flow performance relationship, right? Fixed percentage fee is what we're seeing in the data in terms of the way that the managers are compensated. And we're seeing very large competition between investors. Now, let's take those salient facts and contrast them with the space for alternatives.
So, Jules, for the last 20 years since I wrote that paper, this has been a puzzle in my mind. Why is alternatives so different? So let's talk about it. In alternatives, the data is not like it is in mutual funds. And the way mutual funds work, if you have a track record, it's audited by an audit company, and the SEC requires it. The data is real data. There's no way you can make that data up. It's not true in alternatives. Successful funds either can report or not report. Unsuccessful funds can not report. So the data sources are highly suspect. But if you look at those sources, you find that in alternatives, the alpha is positive on average. So the first puzzle is, why is the alpha positive in alternatives and zero in mutual funds? The second real puzzle is, in alternatives, you routinely see successful managers cap the size of their fund. Now, if you have a line of people lining up to invest in your fund, they must think it's a good investment. So if they think it's a good investment, it means you could make more money. Or another way of saying it looks like the manager's giving up rents. And that to me was the biggest puzzle. I could not understand why managers were giving up rents. Just increase the size of the fund and make more money.
Just to put this in the context of what we just discussed, so in mutual funds, we rarely or never see this, which is that mutual funds cap the size of their fund. In other words, the flow performance relationship that we discussed, which is when you perform well, more money comes to you, you don't disable that mechanism. You're saying that in alternatives, managers are actively disabling that mechanism and saying, we are no longer accepting any more money, even though we're doing well. And that is a puzzle because it means that those managers could be making a larger salary, because if they let the money flow, you would think that would lead to a bigger fund. If you charge some percentage fee on that fund, wouldn't you make more money? Right? And so you're saying it's a puzzle that doesn't happen.
Yes. So why does that not happen? And then the other puzzle in the field is the contract. In the mutual fund space, we show at a time of surprising that the contract is optimal. It's the right contract to charge the manager a percentage of assets under management. Just to put this in perspective, at the time people were talking about this contract in the 90s, all businesses were offering incentive contracts to their executives. And here we have a contract that seemed to be not an incentive contract. You get paid the same amount whether you do well or you do badly. And I would say at the time, this is very surprising because what organization is less opaque than a mutual fund? So you would think that the tying performance to salary would come first in an organization that is the least opaque. And yet we didn't see it. Of course, once you understand the mechanism, you understand that the flow of funds determines the manager's ability. So the size of the fund is the correct measure of the manager's ability, and that's what he's paid on. So the contract is an optimal contract.
Meaning, if you do well, then of course your fund size grows. And even if you have a fixed percentage, you already get a higher salary because of the flow performance relationship. So in that sense, there's still an incentive.
And it's better than using returns because returns are noisy.
Yes.
Right? The investors are smart about interpreting returns, and so the flow of funds is a much less noisy measure of ability. So it's the right measure.
Absolutely.
Why in alternatives do we see something different? Managers are paid both in the size of the fund and as a fraction of performance, usually what I'm going to call the option contract, which means if they do well, they get something like 20% of the upside. But if they do badly, they don't get punished. So I'll call that the alternatives contract. 2 and 20, which means you get 2% of assets under management and 20% of the upside, but you don't get punished on the downside. When it's in mutual funds, that contract would not be optimal. So why in alternatives do we see a different contract?
So 1 second, Jonathan. One thing that I think is really important to point out here, right, is that this is not sort of a statement about, oh, it's a little bit prevalent here, it's a little bit prevalent there. In mutual funds, it's predominantly almost 99.9% is one fixed percentage fee. And in alternatives, it's entirely the 2 and 20 contract that you described. So there's almost perfect separation in terms of these two contracts between these two spaces. That's fair, right?
Yes. And actually, we should be a little bit careful here because one of my colleagues, Julian Bergenar, together with a professor at Harvard, Emil Suridani, wrote a very interesting paper. And when they showed that not all investors in alternatives get the same return. Since they're all investing in the same fund, the only explanation is they're all paying different fees. And at the time it was controversial because everybody thought it was like mutual funds where everybody paid the same fee. But in fact, the paper showed that they didn't pay. And moreover, it's not a function of the fund. It turns out the same investors always get a fee break, and other investors never get a fee break, regardless of which funds they invest in. So that's somewhat surprising. And so the question is, why is that different in hedge funds and alternatives, whereas not like that in mutual funds?
Yeah, because I thought that also from a legal point of view, a mutual fund for all investors in the same share class of your fund, you must give them the same return, right? You have no legal choice but to give them the same return. Isn't that correct?
Yeah, and it's not true in alternative. Of course, it's private markets. So it's contracting, individual contract with individual investors. So each investor is treated differently. But the question is, why is this an equilibrium? And so to give the game away, after 20 years of thinking about this, another colleague of mine, Peter DiMarzo, and I have written a new article and where we think we know the answer now. And I have to say, it's a pretty interesting, and I would say, after I tell you, obvious reason.
Which is what?
So the crucial distinction between alternatives and mutual funds, I would say, is the liquidity of the underlying assets. And let me explain this. So let's contrast two different investments. Contrast an investment in a venture capital fund with an investment in a mutual fund. Okay, if you invest in a mutual fund, you've got liquidity. On any day, you can take your money out. And for that reason, you don't really have to investigate the manager, because you can give your manager a little bit of money. If he does well, you give him some more money. If he does badly, you pull your money out. So you're not really putting that much capital at risk. Now, contrast this with a venture capital fund. A venture capital fund generally has a life of 10 years, and your capital is completely locked up for that period of time. So if you give your money to that fund and the manager turns out to be a bad manager, you're just basically screwed. If he turns out to be better, you can't give him any more money. What does this mean? It means you need to investigate the manager. You can't just give your money to some no-name. And of course, it's costly to investigate the manager. And that is the crucial distinction. In mutual funds, you don't have to do a lot of investigation. But in alternatives, it's not that the capital is locked up, it's that the underlying investments are illiquid.
Yes.
Even if the manager said, look, I'm not going to lock up your capital, he wouldn't be able to give your capital back to you because it's invested in a venture capital company. There's no way of undoing the investment. So you know that you can't get your capital back. And if you know you can't get your capital back, you're not going to risk it on a 10-year investment. You need to do due diligence and you need to investigate the manager and figure out if he's any good. Now, the problem with that is it immediately brings up a free rider problem. Jules, let's say you run the Stanford management company, which is well known to be an outstanding investor and are really good at picking good managers. I decide, okay, I'm going to let the Stanford management company investigate. If I see them invest, I'll invest in the same fund, which means basically I'll free ride on all the work you're doing at the Stanford management company. Obviously, if that free rider problem exists, the Stanford management company is going to say, well, we're not going to invest. We'll free ride off somebody else and nobody investigates. That can't be an equilibrium. So the first observation is any investor who investigates has to get a fee break to make up for the cost of the investment.
Yep.
Okay, let's just take a step back and go back to the mutual fund world. In the mutual fund world, we have this assumption, which is there's an infinite supply of capital for positive NPV investments. What do I mean by that? If I see a positive alpha, there's an infinite supply of capital that'll go to that positive alpha. Let's assume the same is true in alternatives.
Yes. I would even say this is the premise of modern finance. That's what the entirety of modern finance is built on, this assumption.
On that principle, that there's an infinite supply of capital for positive NPV projects or positive alpha investments. So now let's go back to the alternative space. The Stanford management company has to spend resources investigating. If the alpha on the investment was zero, they would lose money. They're not going to do that. So the alpha of the investment has to be positive enough to make up for the investigation cost of the Stanford management company. And so in the world with investigating managers, some investors will make a positive alpha, and if you aggregate over all investors, you'll find a positive alpha, and that immediately explains why it is, in alternatives, you actually expect to see a positive alpha. And, I agree that the data is suspect, but I think there's indirect evidence that the alpha is, in fact, positive. The indirect evidence is the performance of endowments, especially university endowments. Over 30 years, university endowments have had superior performance. I don't think there was an investor on the planet that has had the same kind of performance as the university endowments. And they have predominantly done that by investing in private equity and other alternatives. And so I think that's the best example that, in fact, the alpha is positive and it makes up for the effort these endowments put in to investigate managers.
So, Jonathan, what is so important about what you just said is that right now we're having a policy discussion, and the policy discussion is all about whether regular investors that are investing their pension money should also have access to alternatives and to private equity and these other things, because everybody assumes that they're going to then get that positive alpha too, and it is unfair that they cannot get that positive alpha. But what you're saying is that the only people that are getting this positive alpha are actually the people that doing their investigating. The people that are not putting in any effort or not bringing anything special to the table are still going to be left with the same zero net alpha as they did in mutual funds. Is that correct?
Exactly. So the fee break only goes to investors who investigate. And obviously, when those investors investigate, they invest. And this is very common in alternatives. A new manager will find a high-profile investor who will invest. And then after he's invested, the new manager will use the fact that this high-profile investor invested with him to get other investors.
Yep.
But of course, those other investors will not come in under the same terms.
Yep.
And so that's exactly what Julian finds, right? The same investors always get the fee break. It's because those are the investigating investigators, and the investors are not getting the fee break. They're not investigating, so they're getting a zero alpha.
And what it also shows is that, this idea that there's free money on the table, which is a positive alpha, is still not true, because the positive alpha is just a reflection of the effort that you need to put in. You need to work hard for that. So have you looked at whether the positive alpha these people are getting times the investment that they make is indeed proportional to what investigative costs would look like? Is that a reasonable empirical proxy, or is that work in the future that could be done?
It's work in the future. The problem is we don't get to observe what the actual cost of investigation is. My own feeling is that it's actually more complicated, that there's some investors that have competitive advantage investigating.
For sure.
And they actually make a positive alpha after the investigation cost. And there's some investors who investigate who don't have a particular competitive advantage, but that the investors with the competitive advantage are the university endowments. And really, I think that that's where, if we could get the data, we could really test this theory on that.
So that's empirical fact number one, which is we're observing positive alpha in alternatives and not in mutual funds. You've given an explanation for that. Second one, which is the second puzzle, was why do we see that funds cap the size of their fund? We don't see this in mutual funds. We do see this in alternatives. How does your theory explain that?
The bulk of the paper now is devoted to this question. It's the same question as why is it that they charge a performance fee, right? Why is it 2 and 20? What's the 20 got to do with it? And the answer is in mutual funds, the fee, in economic terms, we say extracts all the rents. In other words, the manager sets the fee, or the flow of funds sets the fee, so the alpha is exactly zero. So they make it simple. Assume there was no flow of funds. The manager could just change the fee every period to whatever the fee is to set the alpha to zero. So he would extract all the rents from investors. Investors would have an alpha of zero. So there's only one dimension you need, which is the fee. In alternatives, we have a second dimension, which is we have to make sure that investors are aligned with managers. So think about this. The surprising result in this paper, which is, really surprised me, is we derive that the contract we see, the 2 and 20 contract, is optimal. Optimal means it's the best contract for the manager, but more importantly, it's first best. The manager is indifferent between managing his own money and taking outside capital. He makes the same amount. In other words, to get that indifference, we have to do two things are required. One is all the rents go to the manager. So that means the alpha is zero, right? It also requires that the manager run the fund at the optimal size. But for the manager to run the fund at the optimal size, he has to know how good he is. And the way he finds out how good he is he looks at what the informed investor, how much that investor invests in his fund. The amount the guy decides to invest in the fund tells the manager how good he is. I guess I should take a step back here. We've assumed, just like we did in mutual funds, that the managers do not know their own ability. When I made that assumption back 20 years ago, we did it for modeling convenience. But I have to tell you, yours and my research, Jules, in mutual funds shows very strong evidence that managers don't know their own ability. And I think it's true. Everybody is overconfident. They always think they're geniuses.
Well, you don't have to go that far. I think that most of the MBA students that we teach that go into investment management find out how good they are by doing it. It's not that when they get their MBA, they know, oh, I know that I'm a great investment manager and I can easily handle $300 billion. None of them know that. So I think it's an utterly reasonable assumption.
Yeah, and more importantly, their superiors know their ability better than they do. And so in this case, the investors, after investigating, after getting to know the manager's ability better than the manager. But the manager has to decide how much capital. And so the way this works is you have to align the incentives. And to align the incentives, you need two dimensions to the contract. So you need one dimension to extract the rents and another dimension to align the incentives. Now, you could say to me, well, Jonathan, you could choose any two. And it's true, you could write what we would call a linear contract. Instead of it being an option contract, the manager is rewarded on the upside and punished on the downside. But what we show in the paper is the option contract gives you the identical amount.
Yep.
But more importantly, you don't have to worry about the manager's ability to pay you in the downstate, right? So both contracts are optimal. But in the one contract, if you have a contract where you punish the manager, you have to worry about the manager declaring bankruptcy and not giving you what he owes you. Whereas in the option-based contract, you never have to worry about that. So in that sense, the contract's superior.
So that's a big victory, meaning that you've clearly provided a theoretical foundation for why an option contract is needed, although you haven't yet explained why it has to be 20%. Why is it for some manager not 5% upside and for others 40% upside and for others 17% upside?
Jules, that's actually, you're getting too complicated. In the paper, we actually show, just like in mutual funds, there is an indeterminacy. In mutual funds, the fee's irrelevant because the fund size adjusts to whatever fee you charge. There's a similar indeterminacy in alternatives. You could pick any one of these characters and they all work. So it's probably got to do with another feature of the industry. But I thought you were going to say, I haven't explained the cap to you.
No, for sure. That's the next one. Absolutely.
And that's the most interesting part of the paper. Here's the role of the cap. When the investor chooses an amount of money to invest, it has to be incentive compatible, which is what the economic term, in layman terms, if he makes the investment, he has to feel as if it is the right for him to do. Another way of saying that is he doesn't want to invest another amount for the sole purposes of fooling the manager. Because then, of course, the fee would be different, right? Because the fee is determined by the size of the fund. And so in order to make that contract incentive compatible, to make it so that the investor always wants to invest the right amount, and then the manager uses that investment to figure out his own ability, what you need is an outside investor. And that's complicated why you need the outside investor. And most importantly, only a specific amount of outside investment. And so the way the contract works is when the manager speaks to a potentially informed investor, the guy says, look, I'll investigate you, but before I investigate you, you have to agree to the contract. The manager will say, yes, okay, here's the fee I'll charge you. And more importantly, I will cap the fund at a function of how much you invest. And what this does is stop the manager from doing the following. Say the informed investor invests a certain amount. If the manager hasn't capped the fund, then he has an incentive to run a larger fund. Because that way he gets more fees for himself.
Yep.
And the way he does that is he discounts the fee to the uninformed lower than it should be and runs a larger fund.
Yep.
That would screw the informed investor. So the informed investor says, no, you've got to cap the fund. You get this very interesting result, which is the uninformed investors are at zero alpha. So there is a cap.
Yep.
And they are prevented from investing anymore, but the alpha is still zero at that point. The cap is not there to stop uninformed investing. The cap is there to stop the manager from discounting the fee to the uninformed to get a little bit more money.
So now, is it important in here that the capping also happens ex ante?
Yes. You set the cap as a function of how much they invest. Because, of course, ex post, the manager doesn't want to cap.
Yes. So that should mean that in the data, we should indeed see not just that managers cap their fund, but they're already willing to commit to the cap of that fund when they start the fund.
Yes, and actually, that's what they do. Now, we can debate how firm the caps are, but when you have a new manager, the first question that is asked to the new manager is, what is your fee and what's the size of the fund you want? And the manager has to answer those questions. So interestingly enough, new managers do, in fact, cap the size of the fund. My guess is they get an initial investor where they give them a fee break. They give them maybe equity stake, whatever. They give them some fee break and negotiate with that investor the fees he's going to charge and the size of the overall fund. And then they go out to raise money and they just say, here are my fee structure and this is the size we're going to go to. We're not going any larger.
Fantastic. All right, Jonathan, let's wrap up. So the paper you wrote with Peter essentially explains three important differences between alternatives and mutual funds. It explains why we see caps in fund size. It explains why we potentially see positive net alphas. And it explains why we're seeing a 2-for-20 incentive contract rather than a flat fee contract. And the main reason that you have brought up for why we're seeing this is that we need people to investigate what the skill of a manager is. That investigation is costly. That costly investigation is reflected in different fees and fee breaks that different investors are going to get. And the incentive contract is mainly determined by the fact
that you need to do two things at once. You have to extract all the rents and align the incentives of the informed investor. So you need two dimensions to do that. The name of the paper is A Unified Theory of Delegated Capital Management. It's obviously available on SSRN, and we'll put a link in the show notes.
Thanks for listening to the All Else Equal podcast. Please leave us a review at Apple Podcasts. We'd love to hear from our listeners. Also, be sure to catch our next episode by subscribing or following our show wherever you listen to your podcasts. For more information and episodes, visit allelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of Stanford University's Graduate School of Business and the Lauder Institute at the University of Pennsylvania. It is produced by University FM.